Practically everyone is obsessed with stock prices. Sometimes people are talking about when it's up, but mostly they are talking about when it's down. Volatility is like tea to investors. Did you see that Rio Tinto is back up, darling? Everybody wants to choose that right company that is going to make them hundreds of thousands of dollars overnight. And of course I understand. Who doesn't want to be rich super fast with little effort? I totally get it, absolutely. But it's not quite so easy just to find the next Microsoft. I doubt it ever was. There was a lot of luck involved. And that's because the market, it can be volatile, and volatility isn't consistency. And consistency? Well, I like consistency. And if you're investing for growth, you need to diversify, perhaps buy ETFs. You need to repeat the phrase, you can't beat the market on a regular basis to your friends. And you need to wait it out for when the market is doing well. Now, I'm not saying that buying for growth is bad. It's actually a very sound strategy, but it isn't consistent, especially when the market is volatile. But dividend investing? Well, dividends get paid no matter what the market is doing. Those sweet dividends get deposited into your bank account either 2 or 4 times a year. And it's not only simple, but it's consistent because it doesn't matter what the price is doing. You're going to get paid regardless. In fact, if you time it well, you could buy a stock and then get the dividend payment in the next month. It could be that fast. But I know what you're about to say. You want both. You want growth and income. And I get it because I also want both. This is what the research shows. Companies that have consistently paid dividends and are growing the dividends over time generally have less volatility and show strong fundamentals over the long term. Not the ones that pay dividends chaotically, the ones that show steady, consistent growth. They also seem to show steady price growth over the long term as well. Now, of course, there is a downside. Nothing is guaranteed when it comes to investing. Because these dividend paying companies tend to be more stable, they are not the ones that double in price overnight. And yes, those companies do still exist, not so much in Australia, but you can still find those companies. It tends to happen overseas a little bit more, and it takes a lot of knowledge and luck to find those. So volatility can absolutely work in your favor. You just have to keep an eye on the price at all times, maybe put stop losses in place. It takes a lot more work, and I prefer more of a soft lifestyle these days. If I am not making videos for this channel, I am not looking at the stock market all that consistently. I might look and see when the dividend payment is going to hit my bank account next, but I am not looking on a consistent basis. I just prefer to keep things simple. These days, I'm more concerned about where I'm going for my next trip or where I'm going for dinner than I am about trying to get an edge in a stock price. So dividend investing is a more relaxed, simple approach to investing because your focus becomes less on the price and more on the consistent growing income over time. And if you're consistently buying, you'll be buying more when the price is down and less when it's up. So it evens out and it's even less stress. So I thought I would make a series on how to invest for the dividend income over the next couple of videos. Think of this as the first one, the introduction video. Next week, I want to discuss ETFs versus individual stocks when it comes to dividend investing. Then we'll move on to how to set up a portfolio, how to do research, how to structure your portfolio, what sort of companies to put in it. So I'm hoping this will be a very helpful series. But in the meantime, I hope the lead up to Christmas is going well, and I'll see you next week. Take care. Happy investing.